Broadcasting from Baltimore, Maryland, and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here is your host, Dan Ferris.
Hello and welcome, everyone, to another episode of the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, a value investing service published by Stansberry Research. We have a really cool show. I can't wait to get to the guest today. You've never heard of this guy, but I think you're really going to enjoy him. But let's get to the rant, okay? Now, if you read the Stansberry Digest, if you're a Stansberry reader, you saw me talking about some stuff on Friday. And if you're a Stansberry Alliance member or an Extreme Value subscriber, you also saw me talking about the same thing in the September issue of Extreme Value, which came out on Friday as well. So I was all up in readers' grills on Friday about one particular subject, and I'm going to talk about that today. I obviously can't give away the advice that I told our paying subscribers in the Extreme Value newsletter, but I can tell you what I told them, which I think is extraordinarily important. It's like this. For a couple of years now, I've been I've been pretty bearish on stocks. And starting in around 2017, I said, look, I expect in the next couple of years, we're going to see the start of a bear market and lots of volatility. And after that, I said, we're probably going to see something like the golden age of value investing. Because what happens over time, over history, over several decades, you see that the cheapest stocks in the market outperform the most expensive ones for several years. And then there's usually a bear market or some kind of ruckus. And then people feel burned by the thing that performed so great that let them down so bad in the bear market. Then they switch to something else. So they buy the more expensive names, the high growth technology names. And then those do well for a while. Then there's a bear market. Then guess what happens? They feel burned by the growth stocks and they go back to the value stocks. So there's this tick-tock kind of change of the seasons effect between growth, the more expensive part of the market, and value, the cheaper part of the market. And so I've been saying, stocks are expensive. We're going to get that moment in the next couple of years. It's coming. It's not here yet, but it's coming. And I've been talking about it for 2 years. And what I told readers on of the Digest and Extreme Value on Friday is what I'm telling you right now. It's here. It started. I mean, do I even need to recount the last 10 years, right? If you look at just you can use the Russell Growth and Value Indexes. They have the Russell 1000 Growth, 2000, 3000, whatever. I use the Russell 1000 Growth Index. That is up more than 400% since March 2009, the last big bottom. And the Russell Value Index is up about 260%, which is nothing to sneeze at, but it's nowhere near 400%. So you can see the very obvious difference. People just weren't interested in value and they loved growth. What happened on Monday, September 9th, is that this whole thing, it turned upside down, like in one day. And our good friend Jason Gefford over at Sentiment Trader kind of called this out to me. Not to me personally. He tweeted it to the whole world, and I subscribed to his letter, and he said it there too to all the subscribers. But basically he said the best stocks, this is a quote from him, the best stocks today, that was Monday, September 9th, are the ones that have been the worst year to date. This is the biggest one-day momentum shift since 2009. I saw another report today in Barron's, earlier this week in Barron's, and they said basically the same thing, that this shift is the biggest it's been since 2000. They said since 2010. But you get the idea, right? Everybody is noticing that there was this massive shift, essentially from growth to value, on one day. And I've been waiting for this, and I've been predicting that this would happen. Now, not everyone is convinced that, the starting gun was fired, as I'm saying it was, on Monday, September 9th. The Luthold Group is a really great research firm, and they're saying, hey, don't get too excited. The Wall Street Journal put out an article that said, hey, don't get too excited. But I'm sorry, I disagree with him. I think this is it. I think the giant turn I've been anticipating from growth to value is here. So what does that mean? Well, what it means is, think of it this way. If you take all the stocks in the market and split them into 10 pieces based on something like price to book value, let's just say. So, you got these 10 slices based on price to book value. So there's, the bottom 10%, there's the cheapest 10%, right? And then there's the next cheapest 10% and so on up to the most expensive 10%. Think of it that way. Well, for the last 10 years, the most expensive 10, 20%, 25%, whatever, has been doing a lot better than, those bottom 10%, right? Those bottom 2 or 3 10%. So the more expensive stocks have been outperforming the cheaper ones. And that, it just turned upside down, as Jason Geffert indicated. And as, the folks in Barron's indicated in an article today. And as if you just type, value and growth and shift, you could probably type any combination of these words into Google. You're going to get a bunch of articles in the Financial Times, like I said, Wall Street Journal. Bloomberg has had a couple of them. This is all over the place. This was not a quiet event. This was a big event. And so that is sort of that was the starting gun. That was the moment that I was predicting. I think there's a couple other things. Really, the one big other thing that kind of caught my eye as a possible indicator is, what I'm calling the failure of the Wework IPO, right? We talked about this last week. And I think that really kind of put a pin in the vision and growth IPO market, right? Until now, all you needed to have a multi-billion-dollar IPO was vision and growth, right? A vision of the world with lots of nice flowery language and, lots of revenue growth. So you combine these two things together, and that explains a lot of IPOs, right? And of course, making a profit, well, we don't need that. Vision and growth replaces profitability, as the important marker for bringing a company public. But not now. I think Wework really, put it this way, who would have predicted in January when they were financing, they took a $2 billion investment out of SoftBank at a valuation of $47 billion. Where were all the articles saying this valuation is going to be cut by more than half and the IPO is probably not even going to happen? There were none. Nobody was predicting that. And yet that is exactly what has played out. Now, I wouldn't have predicted it because, let's face it, this thing has just gone on and on and on for years. And, calling the top of a bull market, ooh, boy, the longer it gets, it should be easier to call, but it's almost harder because we all just get used to it. It becomes new normal. Well, 2019 is anything but normal. Do you not agree? Who at January 1st would have looked forward and said, $1,550 an ounce gold, 7 Chinese yuan to the US dollar? Nobody was talking about 7. It was just 666 as far as the eye could see. Who would have said, May 2019 would be the worst May in 40 years for the stock market? Who would have said August 2019 would have been the best year for the bond market in 40 years? And, who would have predicted the WeWork debacle? Nobody. Nobody is the answer. And of course, I'm sure you'll all send me feedback to say, I predicted it, or this guy predicted it, or that guy. But it wasn't everywhere. And yet it's turned into this weird year where all this stuff is happening. And frankly, it feels very end of cycle. And I've said that many times, I realize, on the podcast. But it's become more intense this year with all these huge, huge changes in financial markets. And I think for me and for my readers, the switch from growth to value is really the big event. And so in my newsletter, Extreme Value, for the past several years, we've done things completely differently. We haven't done the traditional sort of valuation metrics that you do when you're a value investor. We've done some other things and used a different valuation style. I've talked about it. It's kind of complicated. It's called price implied expectations. And it came from a book by a previous podcast guest, Michael Mauboussin, called Expectations Investing. And it really helped us a lot. We found all kinds of stuff that by the headline traditional metrics looked really expensive, but when we applied the price implied expectations model, it was like, wow, this thing is cheap. And so, we recommended, for example, last August, we picked Starbucks, and that thing was up 80% in a matter of months, several months. And that was from August 2018, by the way. So it worked. It was good, but it wasn't the traditional value thing. And what I'm saying now is that the starting gun was fired last week, and the traditional value thing is back on, baby. It's back in action. It's here. So our work is cut out for us, because if you've done any amount of stock screening, you know that there's a lot more names, south of just a couple billion in market cap, let's say, than there are north of a couple billion in market cap. So a lot of these value things are, 1 billion, 2 billion, 500 million. They're smaller, and they're in beat up industries, and they're in difficult businesses. I mean, I've been looking at a reinsurance company, electronics manufacturers. Actually, one was a beat up utility company. The utilities are screaming, but this one was beat up for different reasons. And so there's a lot of different stuff. And each one is sort of a unique situation unto itself. Picking these stocks is a high art because they got a lot of hair on them. You got to be comfortable with a mediocre business. Starbucks is a fantastic business. And we picked some other big cap stocks like Home Depot and a couple others that I'd rather not give away for free. And they've done fine, but assessing those businesses is kind of a similar proposition. They dominate their markets. They generate tons of cash. They have consistent margins, consistent free cash flow. There's a whole bunch of markers where you can just look at the thing and go 1, 2, 3, 4, 5. Yup, it's one of them. But the value stocks aren't like that. It's almost like they're all one-offs. And the only thing they have in common is that they're all dirt freaking cheap, and everyone has avoided them like the plague for 10 years. Of course, those two things go together, right? And one of the insights that I'd like to share with you is that this is a very Howard Marks type of a thing. I've recommended Howard Marks' book, The Most Important Thing, many, many times on the program, in my newsletter, in my living room, to my wife, to my dog. I've recommended the book a lot. And Marx will frequently say, the market knows companies. It knows what the good businesses are. So what are you going to bring to the table that is any better than that? Because you have to do something different over time to get superior returns. If you're doing the same thing everybody else is doing, or if you're doing anything that everybody else already knows about, you're not going to get the superior returns. You got to do something that everybody doesn't know about. And by definition, people don't know about all the stocks they've been avoiding for 10 years. So they're all dirt cheap. Whereas by definition, these businesses like Kinder Morgan and Starbucks and Home Depot and other companies, by definition, those things, they have eyes on them. So they always look kind of expensive. They rarely look, they don't really get dirt cheap. So this is a big shift. It's a different proposition. And it's somewhat of a prediction, because what I'm saying is from this point forward, the value is going to outperform. But I'm really not thinking of it as a prediction. I just think the starting gun was fired. it's absolute historic fact that one day shift in momentum is the biggest such shift in 10 years, documented now in 2 different sources that I've seen. I think this is it, man. I don't know what else to tell you. It's time to buy value. And if you recall, we had Tobias Carlisle on the program a few episodes ago. He's a classic deep value kind of investor. He's done all kinds of great research. And he's got that thing called the acquirer's multiple. Well, that's really just kind of a traditional value screen. It's really kind of like a price to earnings ratio, enterprise value over what he calls operating earnings, or I use the phrase EBIT, earnings before interest and taxes. It's all about the same thing. And it's we discussed on the program, it's half of Joel Greenblatt's magic formula. Greenblatt used, the EV over EBIT, and then he also screened by returns on capital. So he was looking for cheap companies with the EV over EBIT, and he was looking for high-quality companies with high returns on capital. But Tobias' research showed that if you get rid of that necessity to have the high quality, the high return on capital, the returns are better over the long run. It outperforms the magic formula. And so what I'm saying is, now at this point, we've all learned from Warren Buffett, finally, we've all learned to search out the best businesses just in time for it to be a lousy idea. What does Buffett say? He says, what the fool does in the end, the wise man does in the beginning. Well, this is the beginning of buying the cheap stocks again. And it's the end of all these things that have just worked gangbusters for the past 10 years, including, dominant technology companies and just high return on capital businesses, all these wonderful businesses with economic moats and huge competitive advantages. And this is a moment when Howard Marks would say, if you can't see this shift happening, if you just can't see these wonderful businesses underperforming from here, you just can't fathom it, maybe you suffer from a lack of imagination. I would implore you not to do that. It's the best time of my entire career to become a traditional, Benjamin Graham type value investor. And the best way to get started with that is to read chapters 8 and 20 of The Intelligent Investor. You don't even have to read the whole book. You read chapter 8 to figure out how to handle stock market fluctuations, and you read chapter 20 to find out about the margin of safety principle and the 4 principles of business-like investing, which I believe we've discussed in a previous podcast. I don't want to do them now because I want you to read that chapter. But that is really the way to get started, and I hope you do it. And look, if you want to subscribe to Extreme Value, I'd love for you to do that, but I'm not the kind of person who's going to pitch the thing hard at you. It's an expensive product. I don't want people who are going to sign up and cancel. So, I think we have a website called extremevalueoffer.com, and most of the time they have an offer up there. If you're interested, go there. If not, hey, let's just be friends and talk on the internet, okay? So that's the rant, and write in and tell me what you think at feedback@investorhour.com. And now I'd like to talk about what is new in the world. One thing that's new in the world, I haven't seen Ron Paul's name in the news for quite a while. The, I believe now, former congressman is a famous, he's probably the most famous libertarian guy in the world. And his son, Rand Paul, serves in Congress today. And, they're libertarian guys. What can I say? You know what libertarians like? They like the smallest possible government and the least possible taxes, et cetera, et cetera. So Paul is out in the news. He's saying what you and I have discussed and what I've discussed with previous guests. U.S. interest rates are going negative. He thinks they'll be negative. Others have said that as well. And he said the Fed can't stop it, He says we're in the biggest bond bubble in history. We've talked about that, haven't we? And it's going to burst. And hey, the going to burst thing is actually, I think, a somewhat slightly controversial viewpoint. I understand it. Cycles matter. But here's the thing. You can't predict how long interest rates will stay low or how long they'll stay high or when they'll turn. I said, in my rant today that it's a weird year and it feels like a very end of cycle kind of year. I don't know that means interest rates are going to go up by any great amount. It wouldn't surprise me if they did, but nor would it surprise me if they stayed low. So you won't hear me, believe me, in my newsletter over the years, I called the top of the bond market like a couple of times and I got tired of doing it. So, and I'm not by any means the last bear. They say when the last bear is gored, that's the top of the market. But, there are plenty of those around today. And today, we've got, there are different numbers floating around. And there's an indicator on Bloomberg that you can look up. And the last time I looked at it, the peak was 17 trillion of negative yielding bonds in the world. Most of them are European sovereign debt. And let's see, I think the last time I looked at it was like a week ago, and it was maybe just under 15 trillion. So, interest rates take a little tick up and that number takes a little tick down. But hey, maybe a trillion here, a trillion there, you're talking real money. But I say, what's a trillion between friends? 15 trillion is a lot. And I think Ron Paul, he makes a good point about U.S. interest rates. And it won't surprise me at all if U.S. rates go negative, period. So let's talk about this Saudi oil thing. So over the weekend, drones attacked Saudi Arabian oil infrastructure, a processing facility, and put, so we're told, maybe 5.7 million barrels of output per day out of commission. Biggest supply disruption ever in history. And Bloomberg was running a graphic that showed other supply disruptions, various wars and events in the Middle East and things. And it's interesting to me how much of I don't want to call it a non-event because oil was up like 15% yesterday. At one point, it was up as high as 15%. And the futures ended the day, I think, up 12 or 13%. That's a huge move in oil. But the world is different now. And that is something that we have to remember. The U.S. is the biggest producer now. Saudi is the biggest exporter still, but the U.S. is the biggest producer now. And U.S. exporting has begun, and it's legal now. So things are different. And it wouldn't surprise me at all if this were less of an event than people are kind of talking about. Some people are saying, well, this disruption could go on for a while. Oil could go up even more. Oil prices could go up even more. That's not my view on this. And, I don't care who did it. And certainly if, President Trump is convinced that some country or another did it, like, he's saying Iran maybe did it. Yemen, the news reports say Yemen took responsibility, but, Pompeo, our U.S. Secretary of State, and Trump too, in tweets and things, they're blaming Iran. So not sure what all this means. If it means war in the Middle East, well, that could be a bigger disruption. That could cause the price of oil to go higher. So, I don't know. And I thought actually the response from gold was kind of, I thought gold might be up 40 or 50 bucks or something on Monday. And, it wasn't. It was up like, 1% or so. It was, I don't know, 15, 20 bucks or something like that, if that much. It's just a sort of a keep your eye on it kind of a thing. But I don't know if it's as big a deal as everyone says. Okay, Bob Iger next in the news. Bob Iger, Disney CEO, Robert Iger, has resigned from the board of directors of Apple. He was on the board of Apple, and now he's resigned, which makes a lot of sense now that Apple has formally unveiled its Apple TV Plus subscription streaming service, which will obviously compete directly with Disney's forthcoming streaming service. Everybody has a forthcoming streaming service, don't they? everybody's going to quit all the boards they're on. And so, this is, it's not a huge event. But it's something that just kind of shows you that this is serious. It's going to become a bigger, more ferociously competitive thing than it already is. My old friend Frank Curzio was tweeting about it, and he said he's covered tech for decades. Every major technology change of the past couple of decades. Never seen so many giant technology companies trying to storm into something that makes little or no money. Anyway, well, again, that's kind of a wait and see type of a thing. GM, we've talked about GM like a few times over the years, or over the past several months for me on the podcast. But Stansberry has talked about it over the years. Porter's talked about it. They had 46,000 employees who are members of the United Auto Workers walk off the job. 11:59 p.m. Sunday. This is like the first countrywide, nationwide work stoppage since 2007. I mean, this feels like a headline from my youth or something. I was a teenager in the 70s. But the strike impacted 52 facilities in 9 states. No cars rolling off the lines. GM daily earnings losses could hit $50 million. Wow. Per a report by Credit Suisse. So UAW is sitting on $850 million in the strike fund, and they'll pay the strikers $250 a week. So they're kind of dug in. So who knows how far this goes. And, if you own GM stock, which I wouldn't have done anyway, you're probably not real happy right now. How does it come out? I don't know. I hate car companies. I hate the whole idea of investing in a car company. I mean, every now and then you could probably pick a bottom. Maybe if they wind up in my dirt stinking cheap 10% of the market, I'll think about it. But, it's like high, super capital intensive businesses. Think of all the money you got to spend before you make a penny of revenue. And that tells you the bigger that number is, the lousier the business, and usually the more competitive it is. And, they can sort of ill afford, having almost 50,000 people walk off the job and dug in for quite a while with $850 million in their strike fund. So it's just a horribly competitive, low margin, high capital intensive business, and now it's having this kind of problem, which is typical. Union problems are typical of high capital intensive, low margin, highly competitive businesses. It's one of the things you find in them, and one of the reasons why I try to avoid them. Like I said, though, these days anything can be dirt cheap enough, but this thing will have to drop a lot more for me to get interested. And even then, it's so massive, and the liabilities are potentially so harmful. I don't know. I don't know if I'd ever touch it. There are some things that you just never want to touch. Hey, everybody. I just want to tell you real quick about one of my favorite times of the year where I have a lot of fun and I learn a whole bunch of really good stuff. And that's at the Stansberry Conference in Las Vegas. One of the things I love is just we find an incredible number of really high-quality speakers that we pack into this conference. Now, the tickets for the conference are sold out, okay? But you can still see all the action with live streaming. And I've actually live streamed conferences put on by some of the people that are going to be speaking in our conference. And I love it because you can go back and watch the presentations over again and get all the details that you might have missed the first time. So you can stream the Stansberry Conference for $399. You have to hurry up. They tell me the prices are going to go up as we get closer to the conference in a couple weeks here. So just go to www.investorhourstreaming.com and you'll see Dennis Miller, Nouriel Roubini, Jim Grant, Mark Cahotis, George Gilder, just to name a few. And don't forget, of course, your favorite Stansberry folks like Porter, Doc, Steve, and your favorite of all, me, Dan Ferris, okay? That's www.investorhourstreaming.com to sign up. Okay, today's interview guest is Nitin Sacheti. Nitin Sacheti is the founder and portfolio manager of Papyrus Capital, a value-oriented long-short equity hedge fund. Prior to founding Papyrus, Mr. Sacheti was a senior analyst principal with equity contribution at Charterbridge Capital, where he managed the firm's investments in the technology, media, and telecom sectors, as well as select consumer investments. Previously, Mr. Sacheti was a senior analyst at Cobalt Capital and Tiger Europe Management. Pretty cool. Managing mostly the fund's non-European investments. He is also the author of Downside Protection, Process and Tenets for Short Selling in All Market Environments. Mr. Sacheti began his investment career in 2006 at Ampere Capital Management, a consumer media, telecom, and technology-focused investment firm. Initially as a junior analyst, later becoming assistant portfolio manager. He graduated from the University of Chicago with a BA in economics and was a visiting undergraduate student in economics at Harvard University. Nitin Sacheti, welcome to the program, sir. Thank you for being here.
Thank you so much for having me.
Yeah, so I usually start out asking folks who are in your line of work, who actually handle other people's money, at what age did you become aware that a career in finance was for you? When did you start thinking about that?
That's a really good question. So I would say it was in high school. I had a phenomenal economics teacher who actually taught Henry Kravis economics too, and he sort of attributes his career to this particular teacher, and I do the same thing. I think what really engaged me was just sort of all of the information sort of behind the decision making and kind of the logical steps around sort of economics and business and how that affected the world and how the world works. And so I started off in high school, I was kind of reading The Economist, and I, fell in love with the magazine. I think, and then I started to get interested in the stock market, just sort of as a way of kind of manifesting that knowledge that I was, learning. And so I think it was sort of putting all of that together that made me interested in sort of businesses and how businesses operate, how they change, predicting how the world changes and how businesses are affected by that over the corresponding or the next several years. And that was right around the heels of sort of the internet boom and sort of what that was doing to valuations and the overall kind of business landscape. And then on top of that, in high school, I started the investment club with a couple friends. We tried to do sort of real money investing. I ended up doing the same thing in college, founding the investment club, where we had a pool of money that everybody contributed, and we researched businesses. So it was really kind of all along the way. I would say I laugh because I knew so little then versus now, and I'm sure I'll probably say the same thing in 30 or 40 years. But yeah, it was for me, it was just kind of the intellectual curiosity and watching the world change around you that captivated me in terms of finance and in terms of investing.
That's really cool. A high school economics teacher kind of inspired you. Tell me about where you are today. So what specifically, like, when I was reading your intro and I saw, wow, Tiger Europe, I mean, that must have been, working for Julian Robertson's firm, Tiger, must have been really exciting, right? I mean,
yeah, I think that, so one of the most interesting and kind of the best takeaways for me from Tiger was really that, I was in 101 Park with 30 other Tiger seed funds. The floors were commingled to some extent. So, there were just so many intelligent people who had really different business backgrounds before they got into the hedge fund business. And, there were guys who were in sort of the casino business before they were in the hedge fund business. And when I was looking at a couple online gaming stocks, I could walk over to them and get sort of a real education on the business from somebody who was in the trenches. And so I think that was a great value of Tiger, was just being around so many smart people and how welcoming and how team-oriented the environment there was. And then on top of that, I think Julian had sort of a real focus on feet on the streets research. And I think that permeated into all of the seed funds too. And so the value for me from that perspective was, I would say before I joined Tiger, I was sort of sitting at my desk desk, reading filings, reading research, news reports, but I really wasn't going out into the field. And I think, I talk about this a lot in the book, and I feel like that really shaped my perspective, both on the long and the short side, but particularly on the short side, because I feel like to be a great short seller and to really know a business well, you really need to get out to those industry conferences, work the floors, talk to 30 people from 30 different companies who are all tertiarily involved in the industry in which you're researching, in order to develop a real perspective rather than just sort of hearing the company line that management is telling you. And so I think that just broadened my perspective, and that was just an incredible takeaway from working at Tiger.
It sounds to me like what you might say your edge and what you do different at Papyrus is this sort of scuttlebutt, feet on the street kind of a thing. That's got to be a huge part of Papyrus, right?
Totally agree. Yeah. So I would say, any edge can never be one thing. Otherwise, it's too easy to replicate. So I would say the edge for me and for Papyrus is really a few things. So I think you hit the nail on the head. I think that's the greatest edge for me, is really the depth of the work that we do. But then I think on top of that, it's really the temperament. So I think a lot of the shorts that I discussed in the book, we were probably the first, half of the time we were invested in them, we were losing money. And in a lot of cases, we were losing, 30, 40, 50%. So I think there's something to be said about patient investors and being patient and having a great temperament yourself to really put up with the volatility, to sort of watch, situations play out. And I think this is sort of an overarching answer to the question too, though, is that, we're seeing so many funds closing down. We're seeing such moves to passive. We're seeing kind of fundamental active management not working as well and not really beating the S&P as well as it has in the past. And I think that, that's obviously a function of just so much around distortion from central bank easing, which, as well as I do. But I think having that temperament and having that very long time horizon to sort of hold on to a really good business, coupled with doing the really deep fundamental work to know that business, will be around, will thrive, will have a great management team that reinvests capital very effectively to sort of see value grow over time and kind of put up with the short-term volatility from, what happens with the noise around the stock market. I think that's really the edge for me. It's sort of putting all of those things together.
So it sounds like you're selling learning, and you're selling, patience, and let's face it, it's just plain old intestinal fortitude in some of the drawdowns.
Yeah, I think you're right. Yeah, I think it's having the guts to kind of stick through the ups and downs. But I think that confidence comes from the depth of the work. I feel like I wouldn't necessarily be as confident in our positions and putting up with 20, 30% drawdowns in a single name if it weren't for that feet on the streets work that you mentioned earlier.
Yeah, so let's talk a little bit or even a lot about your book. I'm not done with it yet, but I'm really enjoying just kind of going over all the tenets of short selling that you discuss in the opening. And then, of course, you have lots of case studies, which are a little different, and we'll get to that too. And I want to bring Mike Barrett in because he really turned me on to your book. Mike, do you want to, is there some question about this book that you want to ask Nitin that is just eating you up inside?
Well, Nitin, I really enjoyed the process. I'm always interested in finding out how other people approach this investing thing that we do. As a trained engineer, for me, it's all about process and always has been. And so I'm always looking to improve that process. And so that's why I was really intrigued with your book. I've put it out there to our file a couple of times as far as a recommendation. But I do have one question before we get into the details of it. I was curious about the extent to which you consider short interest, or the degree to which other people are short a stock into your process. I don't think you mentioned it in the book, and that's something that we typically pay attention to that. I mean, if the rest of this, if investors are 30 or 40% short a stock, we're we may back away from it. Does that affect you at all?
I think that's a really good point. So I would say there are two ways, at least from my perspective, there are two ways in which high short interest sort of affect a stock. I would say one, that's the borrow cost. And I think there are obviously a lot more long short funds now, and there's a lot more long short money chasing sort of well-known or well-telegraphed shorts today. And so I think that sometimes causes the borrow cost to go up. So that's the first thing. And then I think the second thing is just volatility around a squeeze, right? I think, your incremental short seller might not be the one with the temperament to sort of hold through the drawdowns, or, maybe they're not the one who has, done the deep work to kind of hold through the drawdowns on, a good quarter or two that the company may post. And so I think that sometimes causes pretty violent squeezes in a stock. So what I would say is the first is a definite concern for us because it actually fundamentally affects our returns. And so, if the borrow cost is very high, and I think the one thing I did allude to in the book around borrow cost is that, I was short GoPro in, 2013, 2014. And when we shorted it, the borrow cost was 90%. But the lockup was also expiring a few weeks later. We were short Beyond Meat earlier this year, and the borrow cost was very high there too. But again, the lockup was expiring, and sort of the early follow-on that happened, where the underwriters waived the lockup period, really brought the borrow cost down. So if I can find if I think that high borrow cost is temporary, then I'll still short the stock, even if short interest is high. But I am definitely very, we don't share too many of our shorts for that reason, just because, I don't want the thesis to get out there, and I don't want, the world to start shorting the same stock and, increase the borrow cost for me because, my fiduciary responsibility is to our investors, and that really affects their returns. So so I am conscious of the first and the high borrow cost. In terms of sort of the volatility, I think that's something that I'm not worried about. So if the borrow cost is low, but the short interest is high, I'm still willing to short it if I think it's a great thesis because, one, like I mentioned in the book, we short in small size. Two, I think our temperament is very long-term and our focus is very long-term. So the volatility I just look at that as, a mark. Not necessarily, an impairment of capital. So the latter doesn't really cause me not to short a stock with a high short interest.
Wow, that's a great answer. Yeah. So Nitin, I'm gonna pick your brain as much as possible here because you have a lot of experience. Is it unusual in your experience for underwriters to waive lockup periods? I didn't even really understand the nature of a lockup as an agreement with underwriters before Matt Levine wrote about it recently.
It's so fascinating that you said that because that's actually something I've kind of asked, our attorney to look into because I don't know if it's legal and and to be honest with you, the answer is I don't know because I don't know the answer to that yet. Because the first time I had seen it was with Beyond Meat and I was just really surprised. And I wondered, first question I asked myself when that follow-on came out was, is this legal? And so, for us, my time frame was, okay, the borrow cost is X, but the actual lockup will expire, at this particular time. And so the hurdle is significantly lower with the lockup expiring, 4 months before we shorted it, that the hurdle was, 1/3 of the annualized borrow cost. And so for me, that hurdle was sort of enough to short. But then I would say we got lucky with the lockup expiring early. But I don't know the answer to that yet. But I'll follow up with you on it once I do figure it out.
Okay, thank you. That'd be great. So I want to dive into the book. And I'll tell you, I like to be shocked and I like to be surprised. And it never ceases to amaze me that somebody who's done as much work as you have, let's say on short selling, says something that is completely opposite of everything that I've been told. And the same thing happens to me. I learn all about something and I say, well, this is completely different than everybody told me. And I'm gonna read a sentence from your book and tell you what I mean. It says, I believe Innovators Dilemma shorts at high multiples on peak earnings are the best type of shorts. And what shocks me there is that you mention valuation prominently as one of the characteristics of the best type of shorts. And you know what everybody says. What do they say? They say valuation is a bad way to figure out a short. But, valuation shorts are terrible. And I realize there's another ingredient here, but I was just shocked to see valuation as one of the two characteristics of the best type of shorts.
Yeah. Thank you. So, I mean, I guess what I would say is that for me, like we talk about with longs, you really need, downside protection. And you really need to make sure that, it just goes back to sort of the, original Graham Dodd philosophy, something that Klarman has talked a lot about where, the first, you want to make sure that you protect your downside and your upside will take care of itself. I think it's the sort of the same thing on the short side, but reversed, where if you have a high valuation and it's on peak earnings, then the stock has a lot of room to go down, right? If you have a low valuation on peak earnings, maybe your earnings declines and your stock drops at the same percentage as, your decline in earnings, assuming the multiple stays constant. But the reason why I love these Innovator Dilemma shorts where, valuation is high and and that high valuation is on peak earnings is there's really two ways to win. And if you can prove through the work that this is actually peak earnings, then clearly the multiple will contract also. And so again, going back to downside protection or capping your upside on the short side, the exact opposite. My point and why I like these shorts is because if you're at sort of peak valuation, if you're at, when I talked about Fusion.io at, 50, 60, 70 times forward earnings, my take on that, and that being on a peak earnings power, then it's hard to lose money in the short run while you're waiting for the thesis to play out, because it's hard to see that the multiple will expand any further. And then again, if you're right on earnings, when earnings drops, the multiple, pretty much in every situation will drop with earnings because the street was over extrapolating that high earnings, into the future and putting a growth multiple on, that earnings stream, which they deem to continue to grow.
I have to say, even as you describe it, it still sounds really gutsy to me to say, well, we don't think the multiple can grow anymore because, you never know how crazy something can get, right?
I think that's why the amount of work and the depth of the diligence and kind of modeling the business is so important, because you really need to prove that this is peak earnings. Because I think that, if you can prove that and earnings does decline, and that's why I say it's these Innovator Dilemma shorts, because, the Innovator Dilemma, sort of assumes or conclude it's an Innovator's Dilemma issue if you're concluding that earnings will decline, right? Because what is the definition of an Innovator's Dilemma? It's a company that was the first mover that was over earning, and better capitalized competitors come into the market and effectively compete away that over earning that the innovator essentially did, which is why they're hitting this dilemma, right? And so that essentially entails a drop in earnings. And so I think if you do see that drop in earnings, then I think the stock should decline. Now, that said, one of the other things I discussed in the book was looking at the metrics that the street is also focused on. And, I think I use the example of something like a Tesla or something like a Stitch Fix or a Netflix, where, and we're short both Tesla and Stitch Fix. And so, when for Tesla, for example, the world is not looking and consensus is not looking at the earnings power, right? So they are looking at the number of cars that the company is, selling every quarter. For Stitch Fix, they're looking at the customer growth, not the earnings power generated by those customers, even though the sort of, when you look at sort of the amount of marketing spend that Stitch Fix is spending on a particular customer, that marketing spend is greater than the value that they generate, the cash flow that they generate from that customer over the life of the contract, the life of the customer. So that essentially tells you that every customer acquisition they're doing is actually destroying value, which is fascinating to me, that people still focus solely on customer growth. I think that's changing now. But the point is that, yes, we are looking at peak earnings on a peak multiple, but there are still other factors like, that applies to the names where, like a Fusion.io or like an InventSense that I discussed in the book, where the market is looking at earnings. I think in the case of something like a Tesla or something like a Stitch Fix, you have to look at that other metric on top of sort of peak earnings on peak multiples.
I see. So when people ask me what the Innovators Dilemma is, I say, well, Microsoft and Amazon are dying for you to tell them what industry to take over next. So, just have a great idea, bring the company public, have it grow real fast, and don't make a penny, and then they'll take over and make gobs of cash doing it.
Yeah, I mean, I think that's why one of the tenets, I totally agree with you. That's why one of the tenets was pay attention to the 100-pound gorilla in any industry. And I think that's so much of my work is it's looking at what Intel is doing in semiconductors. Like you said, it's looking at what Amazon is doing in, almost every industry out there now. Again, like you said, Microsoft, it's all of the big companies and how they're affecting their particular industry. Or it's even, smaller semiconductor companies, again, on the theme of sort of an InventSense or a Fusion.io. It's these smaller semiconductor companies that are sort of mid-size in the industry, have their own manufacturing or the lowest cost of production. And when they're getting into a new space in, out innovating one of these, former innovators, I think that's exactly the same thing.
But, still overall, I return to the gutsiness. I mean, it's really like, and I realize you're leaning on deep research, and that's the point that I think, we need to make. But for me, what I lean on, tell me if you do this, what I lean on heavily in that way is when I get, usually it's like even a smaller cap company, but when I feel like I've known the management for years and years, and I can count on their behavior through the cycle. And at that moment, I get really confident.
I totally agree with you. And so, I would say if our process on the short side is my book, our process on the long side is essentially Will Thorndike's The Outsiders. And so we really look for, on the long side, we're looking for great management teams that we think have a real history of capital allocation and are really building value, like you said, through cycles. And so, I've spent a lot of time with the sort of the management teams at Liberty, John Malone's businesses, and we're invested in a few. Sort of, I go out to Denver and meet with them, whenever I can, and a few times a year. Same thing with sort of Charlie Ergen and EchoStar and Dish, and I think these are just phenomenal management teams that really have a very keen eye for capital allocation through the cycles, like you said. And so I think the value, we're also invested in a smaller cap called Hemisphere Media, HMTV, and that's run by, Alan Sokol, who ran the Hispanic media strategy at Leo Hindery's private equity firm. Leo Hindery was the CEO of TCI while Malone was chairman. And so, these are very, very smart people who have been trained well, basically by the best. And, we are so comfortable, like you said, on the long side, even if, the stocks don't move up with the S&P in the short run, just given everything that's happening with QE, I look at these businesses and I think they're trading at great multiples. They're run by great management teams who can steer these businesses through cycles. They're going to accrete cash to the balance sheet at the top of the cycle. And I have to just, not worry about the fact that they're underperforming and understand that when the cycle turns, they'll deploy that cash very accretively. And over a 10, 15, 20-year time frame, like, Will Thorndike highlighted, these companies generate consistent value with a lot less risk. So I totally agree with you. And I'm, and there are also, so one thing that I talked about in the book and I mentioned about Tiger was really the feet on the streets research and just how many of the management teams on the short side that we speak to essentially, I hate to say it, but they basically lie to us about the future, when I'm confident with a management team, exactly like you said, and I've known them for a long time, and I know that they're very honest and very direct, it's a lot easier for me to take what they're saying and sort of model what they're telling me, which, again, like you said, is just so much more comfortable. And I think so much of our business is differentiating between when somebody's telling you the truth or not, and, digging to kind of figure out the truth.
Okay, so I don't want to give away too much of the book, so maybe we could just kind of shift. And do you have like a particular long idea right now that's like your favorite long that you feel like talking about?
Yeah, so one of the longs that we really like here is EchoStar. So this is the smaller of Charlie Ergen's two companies. And so EchoStar, the ticker is SATS, SATS. So this is a business that does rural consumer broadband satellites. So they, you're in the Catskills, and you have essentially either DSL or you have no real wired broadband connection. Their satellites will allow you to get 25 megabits per second in internet, so you can, stream, watch videos, which you otherwise wouldn't be able to do. So it's a very rational duopoly between them and Viasat. Viasat is one of, Baupost's larger equity holdings on the same thesis. I think SATS is kind of more interesting than Viasat given the valuation difference. So essentially, the business generates very good IRRs, sort of low to mid 20% IRRs, just based on the fact that it's a rational duopoly, and they have about 1.5 million subscribers on the two satellites that they have up and running right now, and the addressable market is call it 12 to 15 million households in the U.S. that are sort of in the low end of DSL footprint and or have no ability to get any sort of fixed broadband service. That's not really changing, just given the very high cost to build out, whether it's wireless or it's wired to any of these places. So, I think those IRRs are very good and they're very stable. And this is a business that is underperforming or has underperformed because for a few reasons. One, they were trying to do a large acquisition, so they took out a lot of debt. And so they had a very overcapitalized balance sheet. So, call it $3.5 billion or so market cap, and they had about $2.5 to $3 billion in debt on the balance sheet, and about the same in cash. And so it was essentially a fairly lazy balance sheet. People were upset that they took out this debt and they didn't do anything for a few years. So that was sort of one of the reasons of underperformance. The second was that they had a division that was essentially satellites that sold service to Dish networks for their TV customers. And so that particular business, the majority of its revenue came from Dish, which people saw as a sister company. And so they saw a high revenue concentration, and they saw sort of, dealing between two entities controlled by Charlie Ergen. So I think reasons why the company is sort of misvalued. Now, the reason for that misvaluation sort of start going away as it has the last month or so, or started to in the last month or so, is because one, Charlie essentially sold that business, the business that sold the satellite service for television customers for Dish to Dish. And so shareholders of EchoStar were distributed Dish shares. So those shares were distributed late last week. So what that did was it shrunk the size of EchoStar, and it took out that business, which was a non-growth business. And so it isolated just this consumer broadband satellite business that I was telling you about. And so now the company is a lot smaller. And the growth rate is a lot higher. So you're essentially paying about 5.5 times EBITDA, or what I would say is about 8 to 9 times free cash flow. on maintenance CapEx. So obviously they're spending on these new satellites, and those satellites are generating very high IRRs for them. So if you strip out that new satellite spend and you just look at the spend they would need to kind of keep their current customers and slightly grow, the stock is trading at 8 to 9 times free cash flow. So it's very, very cheap for a good 12 to 15% revenue CAGR over the next 5 years. And now the other side to the story that I think is really interesting here is that, as most people know, because it was on the front page of the Wall Street Journal, a month or so ago, but Charlie Ergen is building the 4th wireless network in the US. So now he's doing that through Dish Networks. And the reason why that was on the front page of the Journal was because the Sprint T-Mobile deal essentially went through because Charlie met with the FCC and Sprint and T-Mobile divested some of their business, some of their, their prepaid wireless subscriber business to Dish and to Charlie. And that was sort of what allowed the merger to go through the DOJ. And so now Charlie is so focused on building this wireless network through Dish that I think it's a very high chance that he sells EchoStar to Viasat. And I think that because he shrunk the size of it by moving that set-top box business and the satellite business that sold satellites to Dish that I mentioned, because that went over to Dish, the size of the business is a lot smaller, which makes it a more likely acquisition target for Viasat because they can actually sort of take it out without, financing that they can't do. And so, I think that the synergies in a deal like this are so large. And I think that this industry is still sort of under the regulatory radar so that, I think a deal would go through. And I think Charlie's willing to part with it because he's so focused on Dish. So, what do I think the business is worth? I think that, at something like 12 to 13 times free cash flow, and they also have some hidden assets in Mexico and Latin America that are just starting to generate sort of on the Latin American side, they're just starting to generate, South American side, they're just starting to generate earnings. And the Mexican asset is unconsolidated and is probably worth another $10 per share on a current, low 40 stock price. So I think that, at something like 12 times free cash flow plus the value of some of these hidden assets, along with spectrum that they own in Europe that's not really being utilized, the stock is probably worth 75 from, low 40s today. I know that was a lot of information. Hopefully,
no, that was great.
I communicated that properly.
In fact, I want our listeners to know this is what somebody sounds like when they've done. Nitin talked about doing deep research, and we took him at his word, but now we know he meant it. So, Mike, do you have anything to throw in here?
No, I mean, I had one other thing that I wanted to mention about the book, if that's okay.
Yeah, please.
Or just throw out there to discuss real quickly. We'll go back to process, and the problem with short selling, what makes it difficult, in my opinion, is that there's always tension in the process. There's all of these things that you look for, and you do a very good job of laying them out in your book of the things that you want to look for. And you look for those things and you find them, and invariably one of those things is in contradiction to the other things. And I think the thing that I often come back to is the one thing you mentioned is don't short a product that customers love. And so oftentimes I find Netflix is an ideal example, I think, of a stock where a lot of the pieces fall into place. But is it truly, what do you think here about Netflix? Is that a product that customers still love to the degree that you wouldn't short the stock?
I think Reed Hastings is a really intelligent guy. When I was in Denver, Charlie Ergen essentially said the same thing. The guys at Liberty have said he's, a very, very smart guy. And he's just really changed the industry. I think that he is a phenomenal, he runs a phenomenal business and he's built an incredible business, and he sort of understands what people care about in terms of his stock and what they don't care about. And he kind of understands the market and the environment with QE, and sort of what he needs to do to build the right business. And he's essentially changed the world, right? And so it's hard for me to short, such a visionary, the business of such a visionary, because I think he'll continue to sort of pull a rabbit out of the hat, which he has done. So that's one thing. The second thing I would say is I guess the problem I have, and I look at the Walmart Amazon example as exactly the same thing. I was thinking about this morning, actually, is that you look at Walmart, and I know this is a little bit of a tangent, but hopefully it proves the point. But you look at Walmart, you look at Jet and what they did there, and you look at Amazon, and the market just views Amazon so differently. They don't view it as an earnings power story, for the reasons we were discussing earlier on Tesla and Stitch Fix. Yet they view Walmart as an earnings power story. So when Walmart does big acquisitions and they effectively dilute their earnings power, you saw the stock go down. And so I guess it's very hard to retrain investors and sentiment, especially in sort of a speculative market like this. So I guess my issue, when I think about that, and I think about Netflix, and I think about just sort of all of the other media companies that are sort of the older media companies, like the Discoveries of the world, and how they are valued on an earnings power basis, I think it's hard to short Netflix because they can do things that these other media companies can't necessarily do in terms of spending money. I mean, obviously it came out yesterday that they got the Seinfeld. They got all 180 episodes of Seinfeld. And I just wonder, the first thing I thought of when I saw that was, how much did they pay for that? Because just given the parties involved and how much they have a vested interest in seeing Netflix fail. And it's sort of like, maybe Netflix paid so much and, on 11 or 11 and a half, whatever it is, $1 billion in revenue, they're spending just about 100% of revenue on content. And no other media company can really do the same thing. So I just wonder if, as they're sort of growing international subscribers, I can't predict when the international subscriber growth will start to decline. But what I can tell you is that I feel like there are a lot of challenges to shorting that, because they're doing things that other people in the industry can't do because they haven't trained their investors to do. And they're very focused on their stock price and their earnings power. So I don't know. I personally feel like there are easier shorts out there than trying to game exactly when Netflix subscriber growth will subside, because I think the market will continue to just look at that, and they'll continue to do whatever they need to, and are sort of given the leeway by their shareholders and by, the street to continue to just grow subscribers regardless of the spend involved. So I think I would say there are easier shorts out there than Netflix. That said, let's compare that to Tesla, which is, a business similarly that's valued on cars sold, not on on earnings power, just like Netflix is on subscribers. And I would say, for me, that's a much easier short, just because it goes back to the competitive angle. On the Netflix front, yes, you're seeing Disney try to do something with Disney streaming. And now you're seeing AT&T try to do the same thing with the Time Warner asset that they acquired. I just don't know if they're ever going to be able to spend the kind of money that Netflix has to really build out that streaming platform, because it massively cannibalizes the rest of their businesses. Whereas when you compare that to the Tesla example, right? Tesla is, I don't know about you guys, but 6 months ago, I went and I test drove the Hyundai Kona EV, and that car was incredible. And it basically drove exactly like a Model S. And it's $40,000, and with tax credits, it's $29,000 or $30,000 in Connecticut, where I test drove it. And so I look at that and I think, it's not Tesla, it's electric vehicles. And I think as soon as you see, a few more competitors, sort of like what you've seen in terms of the reviews of this new Porsche EV. And I think that, in the next 2 years, as you have so many more electric vehicles on the market from better capitalized competitors at lower prices, Tesla is not going to fare very well. And I think it's a great short. But on the Netflix front, again, I don't know if you're really going to see the other media companies really steal share on the streaming side from them, which means, then it becomes a game of predicting when, they saturate the market, which I think is not very predictable.
Okay, Nitin, we're coming to the end of our time here, but I got to say, you pack a mean punch, man. You really provided our listeners with a lot to think about. And if you could leave them, my last question, if you could leave them with just one thought, if I could ask you to do that, what might that one thought be?
All right, I'll keep that one thought short since my answers have been pretty long so far. I would say it's there's no reason to force an answer. I think we're in an industry. I mean, Buffett says it best, where this is kind of the industry where you can, you can kind of wait for the fat pitch. But I would say that sometimes, we force ourselves to have an opinion and we force ourselves to have, come to a conclusion. And I think investing is the sort of business where you have to sort of realize that so many things are out of your control and you're never going to have an opinion on everything. And the sooner you can sort of come to realize that, that you can't have an opinion on everything and some things are just unknowables and you should just pick up and move on to the next thing, I think is what drives, in my opinion, success in this industry, because then you can focus on what you can prove and what you can predict, and you can put stuff into the too hard pile and pass on it. And I think anytime when I look at my mistakes in the past, they've been in situations where I've tried to force a conclusion or force an answer versus just stopping and, telling myself I just don't know and moving on. Okay,
that's a wonderful thought to be left with. So thanks for being here, man. I hope we can get you back in the future sometime. It's been great.
Yeah, same here. Thanks for having me. I appreciate it.
All right. Well, thanks very much. And we'll talk to you again, hopefully soon.
Sounds great. Thanks, guys. I appreciate it.
Okay. Bye-bye, Nitin. That was really great. That guy packs a punch. That's what you sound like when you know what you're talking about. Man, with that, let's go check out the mailbag. So the mailbag is where you and I get to have a conversation every week. It's kind of fun. I read every single email that you guys send me, and I have a lot of fun doing it. And I picked out some of them that are kind of fun this week. So let's get to them. Now, of course, I did these rants about Wework last week, and I did another one about Peloton the week before that, remember? So, we got a little feedback about some of those. Now, the first one is from John M., and he says, Dan, many thanks for your podcast, and I especially liked your recent rant about Wework and CEO Adam Neumann. I have been reading numerous articles about them with amusement, and in my opinion, the biggest red flag was in the S-1 filing. When a company has to include 10 pages of disclosures about its CEO, one has to wonder. And this was before the news came out about him selling the domain name to his own company. Here is my question. What is the difference between Wework's business model and that of a well-established, profitable real estate company such as CBRE? That's CB Richard Ellis. From what I can tell, CBRE buys and rents buildings while Wework rents workspaces and desks. Am I missing something? John M. Thank you, John. First couple of things. The S-1 filing John referred to is the IPO prospectus that every company has to file with the SEC if they want to go public. Next, I don't think you're missing anything. Wework is the one who is renting those buildings from people like CBRE. They're the ones taking on the 15-year leases. And their customers or tenants or whatever they're called, subscribers or members, I think they call them, they're taking advantage of this highly flexible model that Wework has. So when the recession hits, CBRE is still going to be collecting rent. I mean, things won't be perfect. Real estate does have its problems in a recession, but who's going to come out better at the end of it? CBRE or Wework, where, all of a sudden tumbleweeds are going to be blowing through the buildings because these people have no obligation to go past the next 10 minutes or 30 days. So you're not missing anything, John. That's exactly the way it is. All right, next question. This one's kind of long. I won't read the whole thing, but it's a very thoughtful email, and I like it when people write in who have real experience about something I've talked about. So this one is from Steve B. And Steve B says, Dan, I'm an original Alliance member, regular listener to the Investor Hour. Love everything you guys do. I can't wait to get the terminal up and running, by the way. That's a new Stansberry product that we're working on. Anyway, with respect to the Ferris rant about Peloton in episode number 118, I'd like to give some alternate perspective. I liked the rant. It cracked me up, but I think some perspective here might help. And he goes through and he says, he agrees it's, the valuation is probably off and the fluffy disclosures, made him gag. But then he says, as the owner of the Peloton bike and a consumer of Peloton online workouts through a monthly subscription, I do, however, think your understanding is flawed as it relates to the solution to a problem that Peloton provides. Let me explain. And then he basically tells me with a bunch of bullet points that he's a busy guy. He's 45. He's married. It's a 2-income household. They've got 3 young kids. And, he's a busy guy. And so it's better to be able to work out at home with the Peloton, right, than to have to go to the gym. And then he says, so what problem does the Peloton solve? What I just said. He says, it solves the can't get out of the house to work out every day because we're a 2-income family with kids. It provides an extremely time-efficient way to knock out a pretty intense workout in 15 to 20 minutes or longer if you have time. I liken Peloton somewhat to what Apple did with iTunes, like that Dr. Dre statement to Steve Jobs that, wow, someone finally got this right. It's a really nice interface, easy to understand, and I use it as I need it. One of the great side benefits is Peloton also has stretching core strength workouts anywhere from 10 to 30 minutes that I can do in a hotel room because I travel quite a bit. Provides a structured way to track your workouts each month. And maybe most importantly, does a good job of injecting competition energy expended into the group workouts. There's some measure of community there for what it provides. Yes, I'd much rather go out running with a buddy, but remember, I live in freezing Chicago winters. And, then he goes on and makes a few more comments. Best regards, Steve B., Chicago, Illinois. So, okay, I'm not a fitness expert. And I recognize that Peloton is a really nice piece of gear and that it does what they say it'll do. Absolutely. You pay your $2,000 and your $39 a month and you get all the stuff that you just told me about. And that's valuable to some people. Part of my point was simply that if you want to, you can get in world-class shape without buying exercise equipment, without paying $2,000. Certainly without paying $2,000. So you like it, yes, and lots of people like it for $2,000 and $39 a month. Yeah, better like it, right? And I get that. And I get like the research about the short, you mentioned the intense workouts, then there's research about this. But I know for a fact that you can craft an intense workout without paying a penny for exercise equipment. You certainly can. This human body that we have that responds to these things got that way before there was Peloton, before there was electricity, in fact, and before there were gyms and anything else. That's my point. But, you like your Peloton. I get it. Lots of people do. I don't have a moral opinion. It's not immoral to purchase exercise equipment. I just don't think it's necessary. So the next question I've got here is from Sheldon. I think it was Sheldon S. I didn't put that last initial like I always do. Sheldon. Sorry, Sheldon. And he says, this wasn't on Investor Hour, but thank you for your explanation of convertible bonds. I threw that in the digest, in a recent digest in the past couple weeks. And he continues, I assume that since companies can sidestep ratings, the next big thing will be most/all bonds will be issued as convertible bonds. Does this mean that if the company's stock price deteriorates over time, the bond can be converted at a lower cost, especially if they're callable? If that is so, wouldn't it be equivalent to negative great government bonds? Thanks for the enlightenment, Sheldon. No, they predetermine the price where it converts, but I think they can be flexible about it. They can put different terms in the agreement. I'm not specifically familiar with, all the different ways that you can structure a convertible bond. However, you did make this one comment where you said, since they can sidestep ratings, that the next big thing would be most all bonds issued would be convertible. I don't think so. I think this will always be a thing that you will do if you're trying to get around the ratings, because especially now, interest rates are super low. So, man, if you can't just issue regular debt for a super low interest rate, you're you got a problem, and you need to do something, alternative. And this is one of those alternatives. So, I think it'll be that way for at least as long as interest rates are super low. And it wouldn't surprise me one bit if convertibles always remain this sort of alternative path, because look, if your stock price is way the heck up, you could issue equity. If it's way the heck down, it's a garbage proposition to issue equity, and then maybe you're in one of these convertible situations, and maybe they can buy back the debt before it converts or something, or there are different scenarios. I can't begin to play out all the possible scenarios. But the point is, I think it's still true that this is an alternative for kind of crappier companies. Okay, next, Craig R. writes in and with a very short email, but I'm only going to read one line from Craig R.'s email. And Craig R. said, "Peloton is too stupid to live." Thank you, Craig. I don't know about all that, but I appreciate the sentiment, brother. Thank you very much. And I got one last one here. Hi, Dan. Love the podcast. This is from Andy F. Hi, Dan. Love the podcast. Tips for those thinking about shorting Peloton. Buy a pair of Bluetooth headphones and listen to Dan's podcast each week while you work out instead of listening to the spin instructor. Okay, maybe. And that was number one. And then he's got number two. He said, regarding Wework, you mentioned IWG, but listeners may not know that this is the corporate name for Regus, R-E-G-U-S, a big company. He said, I used Regus for a few years. They have good people working for them. Knowing they went bankrupt, it reinforces the challenges of this business model. They're always fighting turnover, which is what I alluded to before when I was explaining the difference between CBRE and Wework. He continues, if there's any success on behalf of the tenant is going to get the scale to want to get a more permanent space. If a tenant is unsuccessful, then they're lost. They're gone. Heads they lose, tails they lose. It's not a bad insight, actually. But he says, back to Weworks, my 10-person firm looked at getting some temporary space from them in case we needed a bridge. We were moving to a new lease. The cost was very expensive, high enough to want to look at other options. Their business model, from what I could tell, was beer. Yes, beer. They sell you in a hip common area where you can get a beer. That was it. Very expensive modern spaces with beer. So you're saying beer then, Andy. Then he finishes up here. Regus is cheaper with the savings. You can buy beer for the entire floor and store it in the refrigerator provided by Regus. Best, Andy F. Andy, thank you. That is a great way to end this episode. I want to also throw out a special thanks to Angelo C. for writing in about Australian franking tax credits. I mentioned that I didn't know what they were and I hadn't looked them up, and he wrote a nice email to explain how it works. But you can just Google Australian franking credits, and you'll find something that will explain it all to you. Okay, that's another episode of the Stansberry Investor Hour. It's been my privilege and a lot of fun to come to you this week. And it is my privilege to come to you every week. It's a great way to spend time with you. And thanks for listening. So look, just go to our website, www.investorhour.com. You can get a transcript for every episode there, and you can listen to every episode we've ever done from the very beginning and get a transcript of every episode we've ever done from the very beginning. And you can put your email in and sign up to get an alert for every episode we'll do from now on. So it's pretty cool. InvestorHour.com. Thanks so much. I will talk to you next week. Bye-bye.
Thank you for listening to the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to InvestorHour.com and enter your email. Have a question for Dan? Send him an email at feedback@investorhour.com. This broadcast is provided for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.